it, and we reinstated the accounts of past, whereby we could straight away claim to any legal authorities that you cannot punish the current management which is trying to clean the scene. A classic example. Right. Here is the good news from Reliance. I think Darius, once again, thanks to your colleagues here, they are supporting us like fantastically. We are taking up any queries on any topic by SMS on my number. Please note down any queries you want to ask. Send your queries to this number. Is it readable? Please SMS your queries now also. Thanks. And that's a great philosophy of Reliance. Spread the technology so that it reaches every corner. Thanks, Darius. Your people are doing a wonderful job here. Are you able to hear me, Darius? Okay. So, we're talking about the reinstatement. If you know the Satyam case, where when Girish Karnik, Deepak Parekh were appointed as the new director, the very next day, Income Tax and PF department started serving notices on them, and they had to go to the government and claim for the immunity, because they said that we have come here to clean up the system, and if you raise the notice on us, which are arising out of the past director's problem, how are we going to solve even for the future? So then government gave them a special immunity. Now IFRS inbuilds in a way indirectly that immunity in this provision itself. If you find something wrong for the past years, one doesn't have to take the onus on him. And many of my young friends may not be knowing that why taking up any jobs become difficult. While we take the advantage of the past good work done by our predecessor, if he has done a bad work, how are we going to take the punishment for that and for no reason? I mean, one should be responsible for the acts which he or she has only done. And that's where this provision was specially brought in. And I'm going to share with you typically the substance and spirit behind every provision possible. We are not here to just see theory slides that you can read. Again, extraordinary items. This concept is not there. If you check up the revised Schedule 6, it talks about exceptional item and extraordinary item. Whereas IFRS doesn't have any such items. Now, this is a very debatable issue. Because even when World Trade Center bombing was done, America did not accept that as an exceptional item. Because they said neither extraordinary item. Why? Because the terrorist threat is there common. It's ordinary, normal threat. Even in India, we know that terrorist threat is always there. So why are we worried about and why are we saying that it is extraordinary? That was the stand taken. What it tries to really promote, and this point can very well be debated, what it tries to promote, therefore, is that if you put extraordinary items, people take the shelter under that, and anything goes wrong is put as extraordinary. On the contrary, the investors should be given an opportunity to compare and question why certain expense has gone up, why the if a particular item is extraordinarily high or looking odd, then why it is high, and that opportunity should be given. An extraordinary item should not be said as tsunami has come, therefore we failed, etc., etc. The protectionist mechanism, the contingency plan, the insurance policies have to be in place. So we cannot be taking the extraordinary items as a shelter. Of course, any management concept is always has two sides and debatable. So it's possible that the extraordinary items are really extraordinary items. But the experience the IFRS body got was that 99% or 95% of the cases, people try to fix the blame on some extraordinary item. And therefore this stand was taken. One should look into the accounting standards, not only that, but what is known as application guidance and basis of conclusion given behind the IFRS. Then we'll get an idea how really it happens. How really it happens means, if the extraordinary items are put, then what happens? And if they are not put, what happens? And application guidance shows that the world survey has proved that the extraordinary items are more camouflaged, cooked. Okay. Are we going to be experts in window dressing of balance sheet? Or are we going as a finance and accounting experts, the praneta of transparency? This is the challenge which is the current generation has to face. And they will have to obviously come on the roads and take a stand, like similarly Anna Hazare has taken. So I'm sure they will take it, because the future of accounting is in the safe hands, as Prabhakar Kalava has said. Interest is also now called as finance cost. Forget calling it interest. Why? Let me share with you some of the cases where again people manipulate the accounts. Of course, I do not want this lecture to become how not to manipulate accounts or how to capture manipulations in accounts. But since I lost my hairs in finding out manipulation of accounts, I can share with you a lot of stories. For example, if there is a loan taken and there is an interest element, and I want to show the interest rate at a lower rate, what I do is I absorb something in discount, I absorb something in processing charges, and I absorb something in premiums on redemptions. And then when I absorb some of the amounts here, if the market rate of interest is going at 10%, on interest cost I show just 6% and fool the shareholders by saying, see how interest rate I have brought down. And the balance amount is adjusted here. Those who are reading AS 30, 31, 32 must be knowing a concept of effective interest rate or EIR. And the time has come that all the youngsters now get into EIR, and instead of finding out what is called as innovative financing schemes, which have no innovations actually, they are all structurings. Okay, they are all camouflaged frauds, just to put it straight. And therefore, interest should be called as finance cost, and finance cost should include each of those elements like discount, premium, processing charges, etc. In the older balance sheet, we used to have lots of columns: secured loan, unsecured loan, dates, current liability, provisions, and we could nicely confuse. And I mean, nowadays I am neither in practice nor in job, so I don't have much of the worries. But I remember, whenever you will ask an accountant, could you give me your current assets figure? He will say, do you want the one which is published in the balance sheet? Or do you want the one which I gave to the bankers? Or do you want the one which I am giving to the creditors for creditworthiness or credit rating agencies? Or do you want the one which I have given to insurance companies? Or do you want the one I have given to the income tax body? Or do you want the figures of what I gave to service tax people? So I have 6 figures of inventories. Which one do you want? That is the kind of answer every accountant gives. My 28 years went into giving such kind of answers. It's an honest confession. All right, but thanks to IFRS, not only IFRS, but also XBRL. This is another tool which we are going to discuss. And I must say, those who are below 25 are lucky, where they don't have to spend time in cooking of the things, but they can be real business partners. In past, the financial accountant was looked upon as a person who helps for cooking of figures, whereas today he will be looked as a real business partner who can use his creative brains, become global, take advantage of the great network created by Reliance, Darius and his friends, and then ensure that this is used effectively to make the transfer of capital flow all over the world. Communication is required for that. And therefore, whatever time I spend in Reliance, I am very proud of it, because the phones went up to the poorest of the person. Today I have a simple mobile of 1,000 rupees, but my maid servant and driver have Blackberries. Why? Because they say it's very cheap. And they have FM and all channels. Alright, going next. Current and non-current liabilities. What are we talking about? And why should we not have secured loan, unsecured loans, current liabilities, provisions? Let me share with you secrets behind this. Secured loans. In my whole career, I must have seen at least 100 companies who have taken loan on same property. Loan number 1, loan number 2. And then what happens? This property loan charge has to be registered, but they will not register the charge. And on the same property, again another loan will be taken. Now all these things have to be disclosed, and therefore IFRS has got the disclosures which are, I'm quoting Dolphy D'Souza here, who is the IFRS god according to me, 2.5 times to 7.5 times compared to the current level of disclosures it is. So that's why I say IFRS can be compared with Bipasha Basu and Mahatma Gandhi. Lots of disclosures to do. Are you aware of any company which has, and this is another puzzle I put, the current ratio, and I'm talking about a cleanly managed accounts company. Current ratio is 6:1. But company is not able to pay salaries for 8 months. 8 months salaries are not paid. How can this happen? So when you ask such kind of question, people give his answer that the debtors must be very high. Inventory must be very high. Lots of deposits with governments have been kept, which are lying in current assets. And that's the precise question IFRS asks. IFRS says, if there are debtors which are not paying for 2 years, why are you calling them current? Are they really current? Question mark. Deposits, electricity, water deposit, till the company is alive, they are never taken refund for. Why are we calling them current? Are they really current? And that's where the funda of current means 12 months or normal operating cycle. Whichever is higher. Whichever is higher, if something can be encashed from the balance sheet date within 12 months or normal reporting cycle, whichever is higher, that will be called as current. And when you see the revised Schedule 6 form, finally revised Schedule 6 has accepted this definition, which ensures that we really make a breakup between current and non-current assets, current and non-current liabilities. Otherwise, we will get such kind of companies. And I have preserved those balance sheets even today. Those who want can write to me where the current ratios are 6:1 and current means asset which can be easily realized, but they have not paid salaries for 8 months. That's where the fundamentals of current and non-current liability, current and non-current assets are coming up. Balance sheet is called as statement of financial position. Now there is a very interesting story